On December 23, 2025, two pieces of economic data were released within hours of each other. Together, they tell a story that should concern every American. First, at 8:30 a.m. Eastern Time, the Commerce Department released the final revision of third-quarter GDP growth, the number 4.3%. That's significantly higher than the 3.8% initially estimated. It's the fastest quarterly growth in 2 years. Markets celebrated. The S&P 500 hit an all-time high. Headlines proclaimed economic strength. Then at 10 a.m., the Conference Board released its Consumer Confidence Index for December, the number 89.1. That's down 3.8 points from November. It's the lowest reading since April 2025, when Trump's Liberation Day tariffs were announced. More importantly, Americans' views of their own family's financial situation turned negative for the first time in nearly 4 years. Think about that. GDP is growing at 4.3%, a rate most economists would consider very healthy. Yet consumer confidence is at levels typically associated with recession or crisis. How is this possible? Because we're not living in one economy. We're living in two separate economies occupying the same country. I've been analyzing economic data for years, and I've never seen a disconnect this stark between official statistics and how people actually feel. This isn't just noise in the data. This is a fundamental divergence that tells us something profound about the structure of the American economy. Let me walk you through what's really happening, who's benefiting, who's struggling, and why this matters for everyone. First, let's understand what drove that 4.3% GDP growth. According to the Commerce Department, strong consumer spending was the main engine. Specifically, healthcare spending surged. Business investment remained solid. Corporate profits increased. On the surface, this looks like a healthy, growing economy. But when you dig into who's actually spending, the picture changes completely. NPR's analysis of the data pointed out something crucial. Wealthier shoppers have been propping up much of U.S. spending at stores and restaurants. Not middle-class shoppers, not working-class consumers. Wealthy shoppers. This isn't a new phenomenon, but it's accelerating. The top 20% of earners account for a disproportionate share of consumer spending. When this group feels confident and continues spending, GDP grows even if everyone else is cutting back. And wealthy Americans have plenty of reasons to feel confident. The stock market is at all-time highs. If you own substantial equity assets, your wealth has increased dramatically over the past 2 years. Real estate values in affluent areas have held up or increased. High net worth individuals have benefited from corporate profit growth, investment returns, and asset appreciation. For this group, the economy is genuinely booming. Their experience of economic conditions is positive and improving. But for the median American household, the picture is completely different. And that's what the consumer confidence data is capturing. The Conference Board survey asks people about their current financial situation and their expectations for the future. In December 2025, for the first time since early 2021, more Americans said their financial situation is getting worse than said it's getting better. Let me repeat that. For the first time in nearly 4 years, net sentiment on personal finances turned negative. Why? Several factors are converging simultaneously. First, the labor market is softening. The unemployment rate recently hit a 4-year high. Now it's still low by historical standards, around 4.2%, but the direction matters. It's rising, not falling, and when unemployment starts rising, it tends to accelerate. More telling is the Conference Board's question about job availability. The share of Americans who say jobs are plentiful fell to the lowest level in 4 years. This is a leading indicator. When people perceive fewer job opportunities, it signals labor market weakening before it shows up in official unemployment statistics. If you're a worker who feels their job might be at risk, or who sees fewer alternatives if they need to change jobs, your confidence in your financial future understandably declines. Second, wage growth is slowing. For several years following the pandemic, workers had unusual bargaining power. Labor shortages meant employers had to compete for workers by raising wages. Average wage growth outpaced inflation, giving workers real wage gains. But that dynamic is reversing, as Michael Zedinak from S&P Global Market Intelligence noted in NPR's coverage. Workers have enjoyed a couple of consecutive years of strong wage gains, but those gains have slowed in recent months. As the labor market softens, workers lose bargaining power, raises get smaller, switching jobs becomes riskier. For workers living paycheck to paycheck, even modest slowdowns in wage growth create financial stress. Third, and perhaps most importantly, there's growing anxiety about job security related to AI and automation. The Conference Board survey captured this explicitly. Zdenek mentioned consumers face this sword of Damocles hanging over their head that AI is coming for their jobs or that mass layoffs are just right around the corner. This is not irrational fear. Companies across industries are implementing AI systems that reduce headcount needs. Customer service jobs are being automated. Data entry roles are disappearing. Even white-collar knowledge work is being augmented or replaced by AI tools. Workers see this happening. They hear corporate executives talking about efficiency gains and productivity improvements through technology. What workers hear is, "We need fewer of you." This creates pervasive anxiety even among people currently employed. If you believe your job might not exist in 2 years, you're not going to feel confident about your financial future regardless of current GDP growth. Fourth, the cost of living remains elevated despite inflation cooling. Yes, inflation has come down from its 2022-2023 peaks. The official PCE inflation rate is around 2.7%, much better than the 7% we saw at the peak. But prices haven't fallen. They've just stopped rising as fast. If your wages grew 3% last year, when prices rose 7%, you fell behind. If wages grow 2% this year while prices rise 3%, you're still falling behind, just more slowly. The cumulative effect is that the cost of basic necessities, housing, food, transportation, healthcare, is significantly higher than it was 3 years ago, and wages haven't kept pace for median earners. For wealthy households, this doesn't matter much. If you're earning $300,000 or $500,000 or more, an extra $500 per month in living costs is annoying but not material. For a household earning $60,000, an extra $500 per month is devastating. This brings us to the core issue, the two-tier economy. Economists have a term for this, K-shaped recovery. After the pandemic, economic outcomes diverged sharply based on income and wealth. High earners and asset owners recovered quickly and thrived. Lower and middle-income workers struggled. What we're seeing now is a K-shaped expansion. GDP grows because the top tier is spending heavily, but the bottom tier is cutting back, stressed, and pessimistic. This shows up in specific spending patterns. Wealthier consumers are still going to restaurants, taking vacations, buying luxury goods. Retailers that cater to affluent customers report strong sales, but mass market retailers are seeing weakness. Consumers are trading down to cheaper alternatives, delaying purchases, and cutting discretionary spending. The Conference Board data confirms this income-based split. While headline confidence fell, the decline was steeper among lower and middle-income households than among high earners. This is economically unstable and politically volatile. When a large portion of the population feels left behind while official statistics suggest everything is fine, trust in institutions erodes. People stop believing economic data because it doesn't match their lived experience. And they're not wrong. For them, GDP growth is irrelevant if it's driven entirely by wealthy consumers and corporate profits. Now let's talk about what businesses are experiencing, because that matters too. For the first time since September 2024, businesses reported a net negative view of the economy in the Conference Board survey. This is significant. Business sentiment often leads consumer sentiment. If businesses are pessimistic, they cut investment, delay hiring, and prepare for slower growth. These actions can become self-fulfilling prophecies that actually slow the economy. Why are businesses turning pessimistic despite strong GDP? Several reasons. First, they're uncertain about policy. Trump's tariff threats create planning difficulties. Companies don't know what trade environment they'll face in 6 months. Second, they are seeing softening demand from middle-class consumers. While high-end spending remains strong, mass market demand is weakening. For companies that depend on broad-based consumer spending, this is concerning. Third, they face their own cost pressures. Even as they implement productivity-enhancing technologies like AI, other costs, labor in tight specialty markets, regulatory compliance, insurance, continue rising. Fourth, credit conditions are tightening. Despite Fed rate cuts, banks are becoming more cautious about lending. Credit is available, but more expensive and harder to access than a year ago. All of this suggests that businesses are preparing for slower growth ahead, even if current GDP numbers look strong. Let me talk about the political implications because they're enormous. In a democracy, economic policy depends on public support. When most people feel the economy is working for them, they support the status quo. When they feel left behind, they demand change. The GDP confidence divergence we're seeing fuels populism on both left and right. On the left, it drives demands for wealth redistribution, higher taxes on the rich, and more aggressive government intervention. On the right, it fuels anger at elites, immigration restrictionism, and protectionist trade policies. Both responses reflect the same underlying frustration. The official numbers say things are great, but my life is getting harder. Therefore, the system is rigged. And there's truth to that. When economic gains flow primarily to asset owners and high earners while wage workers stagnate, the system is producing deeply unequal outcomes. This isn't sustainable. History shows that large-scale economic inequality eventually triggers political upheaval, sometimes through democratic means, elections that bring dramatic policy shifts, sometimes through social unrest and conflict. What would it take to close this gap? Several things would need to happen. First, wage growth for median workers would need to accelerate. This requires either tighter labor markets, which seems unlikely given current trends, or policy interventions like higher minimum wages or stronger unions. Second, essential costs, especially housing and healthcare, would need to stabilize or decline. This requires addressing supply constraints, regulatory barriers, and market concentration. Third, the benefits of productivity gains from AI and automation would need to be shared more broadly. Currently, these gains accrue primarily to business owners and shareholders. Workers who are displaced or de-skilled by automation don't share in the efficiency gains. Fourth, fiscal policy would need to shift toward supporting middle and lower income households. This could mean tax changes, transfers, or public investments in education and infrastructure. None of these changes appear likely in the current political environment, which suggests the two-tier economy will persist and probably worsen. What does this mean for investors and individuals trying to navigate this environment? It depends entirely on which tier you're in. If you're in the wealthy tier, high income, substantial assets, secure employment, current conditions are favorable. Markets are strong, returns are good. The economy feels healthy because for you, it is. If you're in the struggling tier, modest income, few assets, uncertain employment, current conditions are challenging. The gap between official economic strength and your personal experience will continue widening. What am I watching to track this trend? Several indicators matter. First, the gap between GDP growth and consumer confidence. If this gap widens further, it signals accelerating divergence. If it narrows, it suggests more broad-based economic improvement. Second, wage growth for median workers versus high earners. If the gap grows, inequality worsens. If median wages catch up, the two-tier economy starts healing. Third, labor market indicators. Unemployment rate, job openings, quits rate, and wage growth all signal labor market strength. Weakness here hurts workers disproportionately. Fourth, spending patterns by income level. If high-end spending stays strong while mass market spending weakens, the K-shape deepens. Fifth, political polling and sentiment. Economic dissatisfaction drives political change. If enough people feel left behind, policy shifts become inevitable. My personal view is that we're in the early stages of a long period of economic inequality and social tension. The forces driving the two-tier economy, technological change, globalization, asset appreciation, policy choices, are not reversing. This creates challenges and opportunities depending on your situation. If you're positioned to benefit from asset appreciation and technological change, current trends work in your favor. If you depend primarily on wage labor, current trends work against you. But again, I'm not a financial advisor. This is not investment advice. Everyone's situation is different. You should do your own research and consult with licensed professionals before making any decisions. What I am saying is this: don't trust GDP numbers to tell you about the economy most people experience. GDP measures total economic output. It doesn't measure distribution, quality of life, or economic security. A 4.3% GDP growth rate is meaningless to someone worried about losing their job to AI, seeing their wages stagnate, and watching their cost of living rise. The consumer confidence collapse to 89.1 is the real story. It tells you that most Americans, regardless of what GDP says, feel their economic situation is deteriorating. And when enough people feel that way, it doesn't matter what the official statistics say. Their lived experience becomes the reality that drives behavior, politics, and eventually the economy itself. Stay informed, watch the data, but more importantly, understand that we're living in two very different economic realities. Which one you experience depends largely on which tier you're in.